bearish investors today will argue that treasury bonds have plenty of room to rise from here and stocks have plenty of room to decline as financial markets price in a recession. Indeed, if we really are heading into a recession, the average S&P 500 drawdown you experience during a recession is 30%, which could hypothetically take the market back down all the way to 4,400 points. But rest assured, this is not what we're expecting right now. The stock market can experience what's called short-term growth scares, and these can often happen outside of a real economic recession. We have a great example of that in August of 2024. This was a temporary growth scare. We can see treasury bonds during this correction were also rising, just like today, and that proved to be a perfect buy the dip opportunity to ride the stock market for another leg higher. So how can we tell if this is just a temporary growth scare? Well, zooming out to 1982, if we look at what's happened in the last 5 real economic recessions, we've seen what's called initial jobless claims in the United States arise heading into these downturns. Or in other words, layoffs were beginning to pick up before the downturns occurred. And of course, these layoffs accelerated during the actual downturn. When we look at what initial jobless claims are doing today, they've been pretty steady over the last couple of years, not really suggesting that we're seeing layoffs pick up. But there is one more piece of data that's not suggesting that that's the direction that we're heading in. And that can be found on a survey of economic activity called the ISM PMI. This survey shows us the number of new orders that are being made in the manufacturing sector. And as you can see, that's been picking up recently. Now, of course, this is just one survey and is not enough to conclude that the economy is strong. So we can actually add 3 more similar surveys on manufacturing new orders that are conducted by the Federal Reserve itself that are all showing signs of a pickup in economic activity. And going back to 2009, we've really only seen this 4 times before. Once in August of 2009, recovering from the financial crisis, in September of 2013, recovering from the European debt crisis, in September of 2016, in November of 2020, and now we're seeing the same thing today. If we look at what happened to the S&P 500 following all of these instances, it performed extremely well in all 4 cases. As manufacturing new orders picked up, it was a sign of economic strength, pushing S&P 500 earnings higher and so pushing the stock market index higher as well. In fact, when you look at what happens to the PMI heading into and during economic recessions, it goes down and definitely doesn't show signs of turning back up. So we don't think that this recent pullback on the S&P 500 is a sign that we're heading into a recession. We think although there could be a little bit more volatility in the short term, this could actually prove to be a huge buying opportunity for US stocks as stock market earnings see yet another thrust higher against all expectations.